So the first two conflicts of interest are really obvious. There's four main conflicts of interest. Spread and commission. So spread. What's spread? Well, if you buy something, you're buying it in the market, for example, at 6, and if you sell it, you're selling it at 5. So the broker makes 1. You pay the spread. So if the broker has 2 clients, the broker can buy it at 5 and sell it to you at 6. So 1 seller, 1 buyer. They make a spread. So make a spread on every trade and take turns. We'll use this phrase again in a second. The word turn. Taking a turn is buying something at 5 and selling it at 6. So the spread and commission. So spread happens in Forex. There's no commission in Forex. You pay the spread in Forex. You pay the spread in stocks. But in stocks, you also pay commission. So you'll pay a percentage commission to trade in and trade out. So those two are really obvious conflicts of interest, but everyone tries to ignore them for some reason. So what does that mean? Those two things mean that the broker, by default, is absolutely 100% incentivized by volume and frequency. So they want you to trade in the biggest size possible as frequently as possible. So put 2 and 2 together. Why do they lend you 100 times what you put in your account? Because they get paid. The next two are not so obvious. The financing turn and the OTC gain, over the counter. Right, so CFD contracts are over the counter contracts, okay? And when they take the other side and make money, it's called an OTC gain. First incentive, we'll just get it down now. First retail broker incentive, volume and size. Trading as frequently as possible in the biggest size possible. That's how they get paid. The other two, not so obvious, this is how it works. So the first one, financing turn. Who finances the leverage with brokers? Does the magic money fairy from the sky come down and give brokers money to lend to you? Where does it come from? It comes from investment banks. So if you want to set up a retail brokerage company, get yourself $30, $50 million, go to an investment bank, use that money to collateralize some debt, and ask them to borrow $250 million. Ask them if you can borrow $250. You get yourself a revolving credit facility, build a trading platform, and then farm out the credit on the platform to retail traders. So you borrow at, pretty much now, this will be the case, you borrow at 2 3/4, farm it back out for a point higher. So you take a financing turn on the debt. But what else gets collateralized? How do you get away with turning up to the investment bank with only $30 to $50 million regulatory capital and then borrowing $250? How do you get away with that? Because retail traders are going to open trading accounts. And when they put their money in the accounts, that money is collateralized as part of the revolving credit facility. And then you're basically putting the money in your account and sponsoring the broker to lend you money at a point higher. So essentially, you're financing your own rape. Now, of course, if 90% of clients lose money and you want to take the other side, you want to borrow as much as possible so you can take that other side. So of course, you're going to lend out as much as possible, teach people how to trade as frequently as possible in the biggest size possible, so they pay you. You take a point on the financing, and then you get the gain on the other side when they lose. So retail broker incentive 2. Provide third-party financing with no risk or very little risk. Take a turn out the financing and use the credit facility to encourage retail traders to trade as frequently as possible in the biggest size possible and take the other side of all the trades. Not a bad business. And again, why are we looking at this? You need to understand the realities of the industry. Step 1. This is how it works. Step back for a second and think how long it takes you to open a trading account. Quite a few of you have opened trading accounts before. How long did it take you? 10 minutes? What did you provide to open the account? Passport, utility bill, so identify yourself, utility bill, confirm address, you are who you say you are. What else did you have to do? You'll sign some terms and conditions. because they'll qualify you as someone who's got money. Did you read the small print? So in the terms and conditions, what are you actually doing when you sign them off? The only line that matters is one line, and it'll be in there somewhere. I'm happy to lose all my money, and the broker it's not his fault. Broker's got nothing to do with it. It's a risk disclaimer. I'm happy to lose all my money. So that's all you do. Passport, utility bill, fill out the terms and conditions, sign it off. I'm happy to lose all my money. Then what happens? You've got a trading account. You've got access. A total stranger who's never met you is willing to lend you 100 times what you put in your trading account because you provided them a passport, a utility bill, and said, I'm happy to lose everything. Welcome to the world of retail trading. But why are they doing that? Why is it so simple and straightforward? Well, think about the regulators. Passive, don't care. They react. Retail brokers, clearly with these conflicts of interest, are absolutely incentivized to create a narrative around the infrastructure that increases your chances of losing money. In fact, the infrastructure itself is self-perpetuating. Think about it like this. If you own that company where you've got 10,000 clients and 9,000 always lose money, and you're spending 30 to 50% of your money to replace them every month, the ones that are closing down, what happens when a new guy opens their account? Well, you know you've only got 90 days to rape him. So what do? Do you wait 90 days? No, you get on with it. You do it as quickly as possible before he disappears. You've only got 90 days to take the money and take the ownership of that money from his account to your account. So it becomes self-perpetuating. It's a very negative feedback loop. So they're very, very heavily incentivized to make you believe in short-term trading and to trade in the biggest size possible. So they can make the 4 revenue streams: spread, commission, financing turn, OTC gain. So write them down. Make sure you don't forget them. This is how the industry works. Volume and size incentives, spread and com. Third-party financing with a turn, and OTC gain. And this is what the industry looks like. This is what the trading industry looks like, the infrastructure. On the left-hand side, we've got exchanges and investment banks. And everything to the right of that is retail brokers, trading educators, retail traders. We've put a few labels under each. So the investment bank, what are they doing? They're providing the credit facility and clearing to the brokers. And that order flow goes through them electronically down to the exchanges and trades. It all happens within less than seconds. What's the retail broker doing? Well, the retail broker, if we skip the educator for a second, the retail broker is providing the access, so platform and software, financing, leverage, and liquidity. Now that's important because without the brokers, you wouldn't have liquidity. So that's the positive that retail brokers provide to retail traders. You can access liquidity that you wouldn't get anywhere else as a retail trader. So what does that tell you? It's a necessary evil to use retail brokerage platforms as a retail trader. You have to use them. We'll come back to that later. But what type of education do you get from brokers? Well, there's an incentive. There's a conflict of interest. You're not going to get education that helps you make money. You're going to get education that makes you behave like a monkey. Press the button as many times as possible per day until you blow up. And it'll be wrapped up in some sort of strategy. Usually a technical analysis strategy, very short term, less than a day, in hours, in minutes. Follow this line on a chart. Every time this line crosses this line from below, buy. Every time this line crosses this line from above, sell. Signals, very typical. You're not going to get education that works. So they're providing this to the retail trader. What have we called the retail trader? Dumb money. Why? Because they believe everything that the broker tells them. And on the left-hand side, we've got the smart money, investment bank traders on prop desks. Why do we call them smart money? Because they believe nothing that anybody tells them in the market who has conflict of interest. We'll go into more detail on that later. They do the opposite of the dumb money. What's the retail trader paying? Spread and commission. What are they providing? They're providing the demand for the financing, the demand for the false narrative, and the demand for losing trades. So they're providing the liquidity for all of those conflicts of interest. And we have the acronym there, COI. So if you see that in the presentation later, the acronym COI, conflict of interest. And the education is a false narrative. We're going to go into a little bit more detail on how this works in terms of the OTC game and how all of the conflicts of interest work, how the drivers of conflict. So spread, commission, financing turn, and OTC. Believe it or not, it actually happens automatically. It's now all been set up to be automated. It's been going on for 7-8 years already. So if you're only learning this now, you're well behind, well behind. Think of the 10,000 client broker example. What happens when a losing client comes onto the platform and presses the button? Well, at 7 a.m., all the losing clients whose accounts are down go into one liquidity bucket, and all the guys who make money go into another liquidity bucket. The guy who loses money comes on, presses the button. They provide the liquidity automatically, instant. Take the other side. They could, if they want, hedge it. They could go into the market, the real physical market, and purchase the physical underlying asset. So then the brokers short the contract and they buy the underlying asset. But they don't. They stay short the contract. Retail trader loses, comes back, sells the contract back to the broker. Broker buys, closes out the position. Retail traders closed out, brokers closed out. Broker makes money, takes the difference out the account. What have they made on that trade? They've made every revenue stream: spread, com, financing, and OTC gain. And literally, it's all automatic. It's automated software. It happens in a second. So the hedge, if they choose to put it on, will happen automatically down the pipe through the investment bank. It's just a two-way pipe. Now, what happens if it's a guy who makes money? Well, the guy trades, buys the contract on the platform, broker shorts, automatically hedges by buying the underlying asset. The guy makes money, comes back, sells the contract, broker pays the difference into the account after unwinding the hedge. Has the broker lost money? No. So what's the broker made? They've made spread, commission, and financing turn. So they haven't made the OTC gain. What else has happened though? What else has happened in that trade? Look at the green bar. They've hedged. They need money to hedge. Winning clients are annoying for two reasons to the broker. One, because the OTC gain is eliminated, so they only make money on 3 revenue streams. But 2, they have to commit twice as much capital relative to a losing trader because they have to hedge. So winning guys cannibalize the broker's capital. So they're annoying. Losing traders are fantastic because they get the 4 revenue streams and they use X capital to trade with that client. Winning traders are annoying because they make less money and commit twice as much capital, 2X.